Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're doing a deep dive into two sets of source material that feel, well, like they're from completely different worlds.
They really do.
On one hand, we have this high-stakes geopolitical drama playing out in the Arctic. We're talking Chinese research vessels, Russian shipping, U.S. defense strategy, super remote stuff.
And on the other,
The complete opposite. We're looking at the hidden mechanics of finance. You know, that weird late-day stock selling that seems to happen there every year right at the end of December.
right, and it sounds like two totally separate stories, but the mission for us today is to show you how they're both driven by the same thing. It's these invisible underlying structural forces.
The plumbing.
Exactly, the plumbing. Whether it's the plumbing of global sanctions or the plumbing of, strict financial rules, these hidden systems are what really dictate risk and what moves the markets long term.
So for you, our listener, understanding this plumbing is how you connect the dots. It's how a headline about an icebreaker in the Barents Sea connects to that sudden dip your portfolio took right before the new year.
We're going from the sea floor to the trading floor.
Let's jump in. We'll start with the geopolitical side of things up at the North Pole.
Okay, so if we look at the data, the Arctic it's changing fast. It's moving from just an environmental issue to a central strategic crossroads.
And there's new data on this.
Yeah, recent analysis that's been reviewed by Homeland Security and the Coast Guard shows, and they use this word, unprecedented increase in China's activities up there.
Unprecedented. That's a word that definitely gets your attention in national security.
It is. We're talking about a huge jump in the scale and the frequency of their research and observation work, and this really picked up in the second half of 2025.
Now, China's official line is that they're just a near Arctic state doing, pure science. They say they're looking for natural resources, new shipping routes like the Northern Sea Route. So what is Washington seeing that makes them think it's something more?
Well, the activity is what they call dual use. I mean, yes, China is absolutely looking for a commercial edge, shorter shipping times, resource data, all of that. But reports from last summer confirmed something else.
What was that?
They confirmed Chinese vessels, including manned submersibles, were operating very close to the U.S. extended continental shelf. And that level of deep seabed mapping, gathering really specific data on the underwater environment, that just doesn't look like scientific curiosity anymore.
Okay, let's use an analogy here to make it super clear. It's like a builder who spends months creating a super detailed blueprint.
Okay, yeah, a blueprint.
And China's saying, oh, this blueprint, it's just for a new shipping warehouse. Very efficient.
But the analysis from experts, groups like the U.S. Naval Institute, suggests that the exact same data, the seabed maps, the ocean currents, the acoustic data, it can be used for something else entirely.
Instantly repurposed.
Instantly. That blueprint for a warehouse suddenly becomes a roadmap for military operations. It can show you the best submarine routes, where to lay sensors, or even where to cut vital fiber optic cables. It's one set of data, two very different structures.
And this ties directly into the China-Russia partnership,
Right.
Especially with that Northern Sea route.
That's where the sanctions avoidance piece really comes into play. It's actually fascinating how the Arctic is being used to get around international financial rules.
I know the NSR is shorter physically, which cuts transit time, but why is it such a flashpoint right now?
Because it's becoming a formal, systematic corridor for sanctions evasion. We've been seeing more and more reports about this so-called shadow fleet.
Shadow fleet. Sounds dramatic.
It is, but it's not just a few rogue ships. It's a really sophisticated system set up to move sanctioned Russian goods, mostly LNG and oil, without getting caught.
How does that even work?
It's all about maritime subterfuge. They use shell companies, which are basically just paper businesses, to separate who legally owns the ship from who is actually operating it day to day.
So you can't trace it back.
It's very difficult.
Yeah.
And they combine that with turning off their transponders, their location beacons, and using other tricks to hide where the cargo is from and where it's going. It lets them operate totally outside of normal insurance and regulations.
Wow. So the ice itself is providing cover both physically and regulatorily.
Precisely. And the data from places like the Bologna Foundation shows this is a huge structural shift. A very significant chunk of the ships using the NSR in 2025 were either sanctioned or involved in sanctions. That's a massive jump from 2024.
So it's not just opportunistic anymore.
No, it's becoming structurally entrenched. They're using the Arctic as a secure network.
Which brings us back to the U.S. military. If the U.S. sees the Arctic and the Pacific as one unified northern battleground, What's the actual, dollars and cents impact?
Well, the long-term risk isn't necessarily a hot war tomorrow. It's that this whole shift creates these really serious long-term vulnerabilities for U.S. homeland defense, for our subsea data cables.
And the most immediate policy response is this icebreaker gap.
Right? The U.S. is just.
Yeah.
It's way behind in its ability to access and operate in the Arctic,
Yeah.
especially compared to Russia.
And that's changing.
It has to. The data confirms the U.S. Coast Guard is moving to close that gap. They're working with allies like Finland, and they have concrete plans to get new Arctic security cutters in the water starting around 2028.
Yeah.
This isn't a wish list anymore. It's a national security imperative with guaranteed defense dollars behind it.
Okay, so this is the big question for anyone listening. What does China mapping the Arctic seabed have to do with my investment portfolio?
It changes the whole landscape in, I'd say, 4 key ways.
Yeah.
First, like we just said, it structurally increases U.S. defense spending. We're talking surveillance, icebreakers, polar access. That's a sustained tailwind for very specific defense and industrial companies. Second, all these shadow fleets on the northern sea route. They add a permanent risk premium to global energy prices, a kind of tail risk volatility, because those ships create huge insurance and environmental liability gaps. So moving oil or LNG from that part of the world is just inherently riskier and more expensive now for everyone.
And that connects back to the underwater mapping.
Exactly. The focus shifts hard to protecting our own undersea assets. So you see this structural demand for security services and tech that can protect cables and infrastructure. That's something the U.S.-China Economic and Security Review Commission has been pointing out. And finally, the fact that these shadow fleets are working so well, that increases the global risk of secondary sanctions from the U.S. and the EU. And that means much higher compliance costs for every major energy company, bank, and shipping firm in the world. The cost of business just went up.
So structural forces driving geopolitical risk.
Okay, let's pivot now and look at how different structural forces, that internal plumbing, can move your own investments. Let's talk about that weird drop in the stock market that happens in the last week in December. No bad news, economy's fine, but then late in the day, wham, the market pulls back.
It looks like panic, but you're saying it's more like adjusting a recipe?
That's a perfect analogy. What you're seeing is portfolio rebalancing. In the industry, we call it mechanical selling.
Mechanical selling.
Yeah. These huge institutional investors, pension funds, insurance companies, they don't invest based on a gut feeling.
Yeah.
They have to follow these really strict rules, these mandates, to keep a target mix. A classic example is 60% stocks, 40% bonds.
So let's say the recipe for their investment cake is 60% flour, which is stocks, and 40% sugar, which is bonds. But the stocks, the flour, did really, really well all year.
Then the institutional cook has a problem. The stock part of the mix has grown way past its target. Maybe now it's 70% stocks, 30% bonds. They are required to get back to the original recipe.
Regardless of how good the stocks are still doing.
Exactly. It creates this structural mandated need to sell stocks and buy bonds. It has nothing to do with their opinion on the market. It's just a compliance move.
Okay, but if this happens every year, what made it feel so strong in a year like 2025 when stocks did so well?
2 things really amplify the pressure. The first is what we call the thin trade factor. The last week of December, liquidity is super low.
Everyone's on vacation.
A lot of traders are, yeah. So when there are fewer buyers and sellers out there, one big sell order from an institution can have a huge outsized impact on the price.
So a smaller punch lands a lot harder.
You got it. It's why you hear people on trading floors say the plumbing beats the narrative. The mechanics of the market can just overwhelm any good or bad news story in those last few sessions. And the second factor is concentration risk. This was a big one in 2025. When the market's gains are all piled into just a handful of mega-cap tech stocks, think of the big AI names.
Right.
The institutions start hitting their own internal safety limits.
Oh, so they're not just selling stocks to get back to 60/40. They also have to sell those specific high flyers because they're not allowed to have too much money in any single company.
Correct. They're solving 2 compliance issues at once. Fixing the 60/40 ratio and fixing their concentration problem.
We see these big numbers, like a $13 billion sell-off estimate from Goldman Sachs, but you're saying the dollar amount isn't the most important part.
No, it's less about the what and more about the how. We track 3 variables. First is timing. The selling is almost always packed into the end of the day, the last hour, even the last few minutes. Second is the basket of stocks they sell. It disproportionately hits the big index heavyweights, because those are the stocks that drove the outperformance in the first place.
And the third piece is how the trade itself is done.
Yes, the method. These are often program trades or something called market on close, or MOC, orders.
Okay.
An MOC is a huge institutional order that's designed to execute right at the closing bell to get the official closing price.
And when you put those three together,
Late day timing, hitting the big leaders, using these massive program trades, you get those sharp, sudden dips that look terrifying on a chart, but are really just bookkeeping.
but the key thing for a long-term investor to remember is that this is not a sign of a bad economy or bad earnings.
Not at all. And what's interesting is that analysis has shown this mechanical selling creates these short-term, predictable patterns.
Hmm.
If you have that long-term view, these artificial dips aren't a reason to panic. For some, they're actually seen as a brief opportunity to buy quality companies at a temporary discount.
Okay, let's bring this home for the individual investor. Do I need to worry about rebalancing my own 401k, or is this just for the giant funds?
Well, the short answer is yes, you probably do need to rebalance, but your reasons are totally different from a pension fund's.
How so?
A fund does it for compliance. You do it for three personal goals. The first is just risk management. It's making sure your portfolio hasn't accidentally drifted into a risk zone you're not comfortable with. You know, if stocks have a great run and suddenly they're 90% of your holdings, you're way overexposed.
Okay, that makes sense. What's number two?
Automated discipline. And this is huge for avoiding common behavioral mistakes. People tend to buy high and sell low out of emotion. Rebalancing forces you to do the opposite, the rational thing. You trim what's done well selling high and add to what's lagged buying low. It takes the emotion out of it.
And the last one?
Optimization. Unlike a giant fund, you have to worry about taxes and transaction costs, so your rules can be way looser. You don't need to do it on December 31st on the dot. Just aim for once or twice a year, or maybe only when your targets are off by, say, 5 or 10%. It gives you more control and saves you on fees. So if we just step back for a second, the thread connecting the Arctic and Wall Street is this idea of plumbing. Both stories show how these non-fundamental structural forces can drive risk and volatility.
In the Arctic, that plumbing is the network for sanctions evasion and the mandates of long-term defense strategy. It's forcing certain investments.
And in finance, the plumbing is the mandate for institutions to stick to their targets, no matter how good the market feels. The Arctic is a long-term theme you'll see play out in defense budgets, in shipping costs, in subsea security. Mechanical selling is more of a short-term, structural source of volatility, not a warning sign for the economy. So, to leave you with a final thought to chew on, what structural plumbing rules might be governing parts of your own portfolio right now, maybe in your 401k's target date fund, or even just your automated contribution schedule? What rules are in place that you aren't aware of, and how might they force an action you wouldn't otherwise take?
An excellent point. Thank you for joining us for this deep dive. Don't forget to subscribe and hit that like button.